Good afternoon, everyone. I'm Angelica from Optima, and today I want to tell a very simple story about two markets that look noisy on the surface, so namely the oil tankers and dry bulk, but are actually being moved by three quiet forces underneath. And that's where cargo wants to go, how long it takes to get there, and how many ships are truly available when it matters. Think of it as a route geometry, time at sea, and the prompts lists. If we follow those three, the last few weeks make sense, and the next few weeks become easier to frame. Um, Let's set the scene with a 4-week scorecard. Since the end of October, all three Baltic indices have firmed, and the earning prints say the same thing. VLCC averages climb to just over $1,009,000 per day by 21 of November, flirting with a 5-year high, while Capesize spot moved toward the $29,000 per day, with a broader bulker average near 19,800 per day. This, of course, isn't euphoria. It's actually utilization created by distance and days. So cargo taking longer paths, fleet spending more time at sea, and prompt lists that are thinner than spreadsheets imply. Then for the VLCCs, if you read this slide with a lens of root geometry, time, and prompt lists, it actually shows us how this market behaves. Um, Middle East China TD3C keeps gravitating to a narrow working range because the micro does most of the heavy lifting. The surge in Middle East to India bookings has kept position lists tight on both sides of Suez. Relays remain prominent and a big slice of fixing stage off screen, which is why submissions look dispersed, even as cash flow holds in six-figure territory. As long as the first and second decades in the Gulf keep filling quickly, the downside is capped more by time than by price. Step down now the size ladder, and the print still is micro-led. In West Africa, early December stems have thinned, which makes the prompt Suezmax list highly sensitive to even modest pulses of inquiry. In the Middle East Gulf, Suezmax sentiment holds despite friendlier paper supply. So again, that's root geometry overpowering the spreadsheets. Meanwhile, Aframaxes are split by basin. In the North Sea, relays are covering the 23-27 window, and weather keeps STS in play. When waiting days threaten, ballasting away is sometimes rational. So in the Mediterranean, the late November correction has landed. The front end has cleared. Most opening sits in the 21, 26 November band, and owners are trying to plant a floor around world scale 190, which is run dependent. Through all of this, the leadership signal still comes from the VLCCs. Um, why, though, are these flows so resilient? It's mainly policy and path length. OPEC Plus had a measured 0.14 million barrels per day in December and signals a pause for Q1 16, which is supportive into winter without flooding the calendar. US sanctions on Lukoil and Rosneft took effect last Friday, prompting some reshuffling and nudging Indian refiners toward more Middle East and West Africa barrels, quietly actually lengthening voyages. And although there are reports of attacks easing in the Red Sea, um, the system hasn't normalized. Gulf of Aden Arrivals for early November remain about 65% below 2023 averages, and each detour is a slice of time. Aggregate those slices across thousands of voyages, and you manufacture tightness without changing the head count. So let's now cross to bulk and keep the same lens. Two lanes frame the Cape story. C5, which is West Australia to Qingdao, holds around $10.8 per ton on firm early December inquiry. While C3 Brazil to West Africa to China sits near 24.7 per ton dollars per ton with mid-December focus, tighter ballasters and Far East spot constrained by weather. That's a classic utilization mix. So a little less slack in the ballast queue, a little more friction from weather, and suddenly there's enough time in the system to keep prints supported without actually needing fireworks in iron ore demand. Um, Below the Capes, the market splits by basin. So in the Pacific, Panamax still trades like a range speeds of 15 point 15,500 to $16,000 per day versus offers of 17,000 to $18,000 per day, because Australia and North Pacific inquiry is actually a little patchy. So in the Atlantic, the tone is steadier. U.S. Gulf grains and U.S. East Coast coal support the December programs. TA rounds remain quiet though, and the East Coast South America holds around the mid 16,000 dollars per day. Call it sideways with upside optionality if programs hold, and that Pacific bid offer gap narrows. Um, Supramaxes and Handies rhyme. Actually, with that picture, the U.S. Gulf has firmed versus last week on grains. The South Atlantic is firm to positional. Continent Mediterranean is steady, and Asia looks muted on fixing, but not weak underneath. It's shoulder season behavior where grains do more of the lifting than the screen suggests. And again, time and path, not exuberance. Um, there's also a structural note worth flagging because it matters beyond quarter end. So Simandou is moving. The project has been inaugurated. The first cargo is loading by barges onto a Newcastle Max, and the nameplate sits close to 120 million tons per annum on a multi-year ramp. Over time, that adds a new long-haul iron ore leg into China, a slow burn addition to route geometry that actually diversifies an Australia heavy map. It's not a reason to chase today's print. It's actually a reminder that cycle mechanics aren't static. All of these sits on top of supply that looks louder on spreadsheets than it feels on the water. So year to date, we tally 352 bulker orders and 297 tanker orders. S&P has been brisk with 68 crude carriers, 107 product tankers, 486 bulkers, and actually recycling is up on last year, but still historically low. Japan's $135 billion stimulus includes shipbuilding, a medium-term supply signal, not a Q1 timing risk. So near-term net supply discipline still comes from speed, surveys, and off-hire, and the detours we've been actually discussing. Your fleet development slides put numbers to that message. In dry bulk, the order book ratio has stepped up to 200.27% of the fleet, a move actually concentrated in over Panamax, and Capesize, while Ultramax still carries the largest percentage book and Supramax Handy remain anemic and aging. Growth expectations for 2025 and 2026 are essentially unchanged. Utilization into 2025 is still a demand and time equation, and any supply risk is clustered, not universal. In oil tankers, the order book has risen to 1,129 ships, or 19.15% of the fleet. The monthly step-up sits with VLCCs and Aframax LR2s, where owners have locked yard slots into strength. While 2025 growth eases to 2.2%, and 2026 now just higher to 4%. So that pushes risks to the back end of the window. Between now and next summer, ton miles and time still drive the print. So for late 26, the debate becomes absorption, speed discipline, and whether the tours truly normalize. Um, what do we watch from here? For VLCCs, whether the TD3C band holds, your dashboard still has world scale 125, 130, with realized DCs above 100 K per day, and whether the Middle East Gulf decades keep covering quickly. For Suezmaxes and Aframaxes, we watch whether West Africa stays thin and the Med can defend something like a floor near world scale 190. For Capes, whether C5 remains steady while C3 stays firm as ballasters tighten, and Far East weather keeps stilling days. For the middle sizes, whether the U.S. grains and U.S. East Coast's coal maintain rhythm, while the Pacific bid-offer gap narrows. And for route geometry wildcard, whether Gulf of Aden arrivals truly normalize or detours remain sticky a little longer. When two or more of these lean positive together, utilization accelerates faster than the fleet math would actually suggest. So let me close where I began. Markets like these look like they are about price, but it's time that pays us. The last month rewarded ships pointed the right way at the right moment. VLCCs on long haul into Asia and India, Suezmaxes that stayed close to action, Panamaxes and Supras that hugged the grain's pulse rather than chasing a quiet Pacific. Um, Meanwhile, the fleet math will have its say later. So for now, utilization is coming from route geometry, time at sea, and the way prompt lists really look when you open them. So keep your eyes on those three levers, and the noise becomes actually a map. That's it for this month. Thank you very much, and see you next time. Thank you.